Welcome to The Real Deal, where it's all about real estate and related businesses in central Massachusetts and northeastern Connecticut. And now, your host, Anthony Chabot of Chabot & Associates.
Hey everybody, and welcome to the Real Deal Real Estate Podcast. My name is Anthony Chabot with Chabot & Associates Real Estate Group of EXP. And on today's show, we have a very special guest that I'm excited to interview. I've been trying to get him on the show for a couple months now, and he finally agreed to do it. Mauricio Rauld of Premier Law Group. Welcome to the show, Mauricio. Thanks,
Anthony. Thanks for having me. Really looking forward to it.
So Mauricio is into something that I am very interested in. He specializes in... He's an attorney for real estate apartment syndication. And I met him at a Newton, Massachusetts meeting, Massachusetts Multifamily Investor Group. And thanks, Matt Paceni, for that great group over there. But Mauricio was the star speaker of the night, and he did a great job. He stood up on stage and gave a presentation for about 45 minutes. I was kind of hoping that we could touch on some of the things that you spoke about at that event that night, because it was really interesting, and I kind of got the impression that you might have a book coming out. Is that something that you might be able to talk about, or no?
Yeah, I mean, I've got it. Actually, it's an ebook. I don't want to get too carried away. It's kind of blown up a little bit from my original idea, but it's an ebook, and it's just a thorough ebook called "The 5 Things Every Syndicator Must Know to Stay Out of Jail." And so I kind of highlight the 5 things, and it's been fun, but it's taken a little bit longer than I thought to get it done.
So you did a great job up on that stage that night, and where are you from?
I'm down here in Southern California, in a little place called Newport Beach, and I've moved around a little bit, but basically for the last, 30 some odd years, I've been down here with a little break where I spent some time in Belize, believe it or not, and spent a little time in Austin, Texas.
I heard Belize is actually an interesting spot specifically for real estate investments for some reason. Is that true? Did you learn something about?
Oh, it's a great place. I lived on a little island that probably where 75% of the people go and the tourists go, and it's a wonderful place in the Caribbean, very undervalued. So it's a very attractive place for real estate investors because it's starting to get discovered, and so more and more people are heading down there to the islands, and because of that demand, there's a percentage of people that end up buying something there, and so real estate's been really hot over the last decade or so. Actually, more than that. It was actually pretty hot even before the last recession, and it just continued up until now.
So what is your business name, your web address, your email address, phone number, people can reach you?
Yeah, so I'm the founder and CEO of Premier Law Group, and so website's premierlawgroup.net, and there's actually contact info that you can just click on a link right there and get a message to me. So always happy to talk to any of the listeners of your podcast. Would be happy to hop on a call or answer any questions that kind of follow up from this. And I'm a syndication attorney, so it's kind of a fancy way of saying I'm a securities lawyer, because what I do is I help clients raise capital, raise money in full compliance with there's federal and state laws you got to think about, and so I just make sure that when you're raising money, we'll talk about what that means and why, but there's a whole world of securities compliance that you've got to worry about, and my job is to make sure that you navigate it without stepping on any of the landmines.
Yeah, and that's pretty much what your speech was about that night. And so I'm very new to real estate syndication. It's kind of a new topic of study for me. In the past, I would say maybe 6 months or so, I've read multiple books on it and listened to a bunch of audiobooks and listened to a bunch of podcasts and talked to a bunch of people that are interested in or that do it for a living, actually. And I would say probably you and Matt are two of the top people that I'm just totally blown away by what you guys have accomplished and all the things that you've done over the years. You're also can be found on a lot of, you have your own, do you have your own podcast or no, you were on the Real Estate Guys podcast, right?
I feel like I've got my own podcast. I do quite a bit of podcasting and a lot of repeats. I'm probably most well known for being on the one of the Real Estate Guys podcasts. I'm one of their advisors. I've been Robert Helms' attorney for the last 15, 20 years. And so I've been on that podcast, I don't know, 5, 6, 7 times. And that's where most people kind of know me from, the real estate guys. But, dude, it seems like I do 1 or 2 podcasts a week. And so I'm thinking about doing my own podcast, but I'm kind of busy doing everybody else's podcast. I've been advised maybe to just keep doing this. But, if you Google my name, you'll probably see me on a bunch of different podcasts.
I have, and I've watched a lot of them. And it's really interesting. I study this stuff. I kind of stalk all the people that are the syndication experts, and I just listen. I just absorb it all, and maybe someday I'll be in that area with you guys. But in the meantime, I'm just trying to kind of get my bearings with all of the large multifamily complexes. I do a lot of multifamily properties. I'm a real estate agent in Connecticut and Massachusetts, and I really have gravitated toward the multifamily space from the beginning, commercial actually originally, but then I realized the opportunity that was there with multifamily, probably because of people like Grant Cardone and Bigger Pockets. But then it turned into more because I realized there's all these local groups that you can be part of, the networking associations and the groups. And the next thing you know, I'm talking to just a huge network of even local people in Massachusetts especially. That it's really huge. There's a lot of community that's in between investors, lenders, realtors, property management companies, and contractors. Tony No is another one, NGO. I don't know if you know him, but I talk to him all the time. He's a great guy, full of enthusiasm. So anyway, I don't want to talk too much. I want to interview you more than talk about myself. But how can people get started in syndication if they wanted to use you as their attorney? How does that process work? How do they get started? What's the first step you would say?
I mean, I guess the first step is, if you're not a syndicator, is to make that decision, right? Do you want to go into a space where you basically scale or move up, is the way I kind of like to say, where you're originally maybe buying kind of what you're doing, buying some real estate, single family homes, maybe even a multifamily, maybe even partner with one other person, and the two of you or 3 of you kind of, split your resources and time and go do something. And at some point, what typically happens when you get that real estate bug is that you run out of money. You run out of your own cash, right? And so at that point, you've got a decision to make. The decision is, well, I'm out of money and there's nothing else I can do. I just have to wait here and sit back and wait for maybe some appreciation to happen. And that way I can pull some money out, refinance, and go do another deal. Or do I start syndicating, which essentially means, do I want to go raise money from third parties with other people, where they're just giving me the cash. They're not involved in the day-to-day or really involved at all in the operations or any part of the business. They're basically literally giving me cash and then using that cash to go, continue to buy properties or maybe buy bigger properties. Because obviously, if you're looking to do a multifamily property of, even if it's a relatively small one of, 15, 20, 30, 50 units, we're still talking, depending on the market, potentially millions of dollars. And so if you're looking to put down 20% plus your costs, it's a significant amount of money that most people don't have. And so if you want to get to that next level, then step one is just to understand, if you want to go raise money from individuals, there's a lot of responsibilities, obviously, that come with that. A lot of people aren't comfortable with it. There's one thing for you to invest your own money, and if it goes wrong, whatever, you've lost it, but it's on you, or maybe you and a partner. But certainly there's a level of responsibility when you start taking investors from, or money from, maybe friends and family, or maybe even people you don't know. And so it's just, that's probably a good sign, by the way. We always joke with the real estate guys that, how many of you, we always ask at our seminars, how many of you feel just a little bit uncomfortable with the idea of taking other people's money and being the steward of their money? And a lot of hands, most, if not all of the hands, go up, and that's a good thing, because what you don't want is people to not really care and say, I don't really care about other people's money, I'm just going to go do it. That's probably not if that's your attitude, it's probably not the right one. It is a big responsibility, but it comes with a lot of rewards, not only for you, but for the investors. I mean, at the end of the day, you are trying to come up with an investment and a return that's a win for your investor. And as long as you focus on that, I mean, Zig Ziglar, one of my favorite personal development coaches, always used to say, you can have anything you want in life as long as you can provide what everybody else wants in life. So as long as you can handle what everybody else wants, which is a good return and a safe return, look, there's risk in everything, but if you can offer them an alternative to the stock market or their, savings account or CDs or whatever they've got their money invested in, that's a win for them, and as a result of that, it's a win for you.
So can you give kind of an overview of syndication and some of the different aspects of it, like the general partner, limited partner? You'll be able to explain it better than I can. And then also the the different, is it 560 A and B?
Well, we can talk about the exemption. So let's just start from the beginning. So like syndication is simply the process of pooling other people's money. It's really pooling resources. So it's not just money, by the way. I mean, you could pool credit and knowledge and relationships and time. I mean, there's a lot of resources that you can do it. But typically when we talk about syndication, we're talking about pooling money, meaning I have a little bit of money, but I need $100,000 or $500,000 or $1 million, and I go raise that from the outside world with a business plan. I basically make a presentation and say, look, I'm looking to buy this big property. This is what it looks like. Here's my game plan. Here's what the returns look like. Here's the exit strategy. Would you be interested in investing in my syndication, in my real estate project? And what most people that are starting off, especially when they're thinking of maybe doing maybe you're just thinking about doing a single family home that you want to buy with 4 or 5 of your friends. What most people miss is that anytime you take money from people, from investors, where the returns are generated by your efforts, you're doing all the work and the investors are simply passive, they're writing you a check and then going home, you are dealing with a security. You're actually issuing securities, even though you're buying real estate, you're issuing securities, usually, like you mentioned, in the form of an entity, which is usually a limited liability company. So usually you create an LLC, and that's really what you're issuing, shares in that company, in this case, to be membership units. That's the security, and that's why the SEC is involved. That's why the Securities and Exchange Commission is in your face, even though you're buying real estate, and you may think, well, why is I'm not selling securities, I'm not buying securities, I'm buying real estate. But that's the reason why the SEC is involved. So once you recognize that, then a couple of things happen. The first one is obviously now the whole world of federal and state securities laws comes into play, which is why somebody would call somebody like me, because I can navigate those, I know what the rules are, and I can just make sure you're doing it without violating those rules. But really, at the end of the day, it's not big picture. It's not that complicated. Look, at the end of the day, if you're selling securities, which you will be, there's 3 things you need to focus on. One is you may have to register that security with the SEC, the Securities and Exchange Commission, which is an awful thing to do. Or you can find an exemption to that registration, or it's illegal. Those are your options. Register, find an exemption, or it's illegal. Obviously, we don't want to be doing illegal stuff, which is why clients call me to make sure they're doing full compliance. We don't register securities because that's just a ton of money and a ton of time. I mean, that's going to take you, that's basically going public. In fact, you're not going to go public when you're buying even a high-priced apartment complex and you're raising a couple $1 million. You're not going to spend the next 2 years of your life in 6 figures, 7 figures sometimes, going public and registering it with the SEC. That's just you just don't have the time, even if you wanted to. And so we're always looking for exemptions to registration, which is what you mentioned. You just mentioned one of the rules, and the rule that you're mentioning, which most people rely on, is a rule called Rule 506.
506, okay.
506B as in boy, and that's an exemption to registration. So when we follow the rules that are enumerated in Rule 506B, we are alleviated from the responsibilities of registering, and we're also alleviated the fact that we're doing something illegal because we're following the rules. And so that's my job, is to, number one, figure out what exemption we should be relying on, because there's several of them. That's the most common and most likely your scenario. But number one, identifying it, and then number two, just making sure that we're structuring the deal and we're taking the steps necessary to comply with the elements of that rule. Because if we don't follow that rule, then we got to find another exemption. Because again, we either, if we don't register it, which we don't want to do, we need to find a different exemption if we can't fall under the rules of this particular one.
So is it 506A and B or 506?
It's 506B and C.
B and C, okay.
Yeah, it used to be 506 period. That was it, 506. And then in the last time we had a recession, there was a Congress came past what's called the Jobs Act, JOBS, and part of that Jobs Act made a change to the rule, or actually an addition to the rule. One of the 506B now, what it's called now is 506B, which is the old regular 506. Is a wonderful exemption, but the biggest drawback of that exemption is that you're not allowed to advertise or solicit your deal. So, because it's supposed to be a private offering, it's supposed to be for your friends and family and people that you have a close relationship with. It's not something you just go advertise, right? And so that was a limitation to access, right? I mean, if you only could go to people you had relationships with, there's only a finite number of those people, and especially if you're doing number of syndications, at some point those people get tapped out. Maybe after you've done 2 or 3 or 4 or 10 or whatever, you run out of people or you run out of their money. So first you run out of your own money, then you run out of the money of your friends and family. And so people wanted to expand their network without having to go the public route, again, registration. And so that's where, because of the recession and everybody really needed to get capital, Congress passed this law in 2012. But then 506C came online after all the regulators to get through all the processes in September of 2013, and they allowed us to actually advertise and solicit, which was back then groundbreaking. We couldn't do it before, prohibited, and then suddenly we had this option now of advertising. So we could go on podcasts like this and basically scream from the top of the mountain, "Hey, I've got a deal, invest with me." And so that's what 506C was. Now there's some limitations to that, which we can talk about, but that's the main difference between those 506Bs and 506Cs is the ability to advertise under one of them, which is in theory anyway. It's a nice tool in our toolbox, but for whatever reason, it hasn't been adopted as well as many people thought. There's still the vast majority of people still do a 506B as opposed to a 506C, and there's some movements that kind of loosen up the rules a little bit because of that.
So the easy way for me to remember this, because this is not something that I happen to deal with on a daily basis, like I hope to in the future, but 506B, behind the scenes, 506C, clear to speak about publicly. Behind the scenes and clear. Easy for me to remember that way. So,
that's a good one. Yeah.
So what's B is non-accredited investors and C is accredited investors. Is that right?
In a 506B, in both of them, let's go with on both of them, you can raise unlimited amounts of money. So that's a nice thing. Like if you're just starting out, that probably is not a big deal. That if you're limited to 5 million or 50 million, that probably isn't a big deal for a first-time syndicator. But once you get into this quite a bit, and you're trying to raise tens of millions of dollars, or maybe like the big boys who are raising billions of dollars, and those guys still rely on 506B, but there's no limit. You can literally raise 10, 20 billion dollars as some of these investment firms have. But under a 506B, you are allowed to accept some of the non-accredited investors. These are people who don't have high net worths or high incomes. Specifically, they don't have $1 million in net worth, excluding their primary residence, or they don't earn $200,000 or haven't earned $200,000 for the last 2 years with a reasonable expectation of earning $200,000 or more this year. So it allows you, again, for a first-time syndicator who might be going to friends and family and maybe wants to go to Aunt Jenny, as I always joke about, and Aunt Jenny happens to be non-accredited, you can make these deals available to the non-accredited investors as long as they're sophisticated, but you're limited to 35, which, again, if you're just starting out, you may not be thinking of getting 35 investors anyway. Maybe you're thinking of getting 5, 10, 15. But there's a limitation of 35 non-accredited, but they are allowed. Under a 506C, because you're allowed to advertise, the rule makers, Congress said, well, we're going to allow you to advertise, which is great, but we're going to limit you to accredited investors only because you don't know these people that well and you don't have a relationship with them. And so we want to make sure that you're only talking to people who presumably are more sophisticated or at the very least can afford to lose whatever investment they're making. If somebody writes you a $100,000 check and they're non-accredited, that's most likely a high percentage of their net worth or how much they make. When they're accredited $100,000 or $50,000 or whatever, it's not as big a deal if they end up losing it. Or really, sometimes you have to put in additional capital. And so, maybe if I need another 50 grand, that's much harder if you're non-accredited than it is than if you're accredited. So that's really the main difference, kind of keep it really at the basic level, is with the 506B, you can take up to 35 non-accredited investors, but you cannot advertise. You have to limit it to people that you know. You have to have a pre-existing substantive relationship with that investor. So again, somebody you just have known for a while, or at least before this offering. With a 506C, you can advertise, which is the good news. The bad news is you can only accept accredited investors, and you must take some steps, some reasonable steps to verify that they're accredited if they're 506C. You can't just take their word for it. With our B raises, we just give them a questionnaire and they tell us they're accredited and we can rely on that.
Mm-hmm.
With a 506C, we've got to actually look at tax returns or brokerage accounts or whatever it is that we need to prove that that investor is in fact, accredited by either income or net worth.
Is there some sort of a standard return on investment? Because I keep hearing, between 18 and 20% ish, somewhere in that neighborhood, as kind of like a number that just keeps popping up. And, to be honest with you, I don't know if that's, sometimes I hear a little bit lower, sometimes I hear a little bit higher. And then that's actually including the appreciation, I believe, because the year to year, I think is. Yeah, look,
what's a good return will depend on a lot of factors. The risk, obviously, of the investment. You always want to think of returns. You don't want to think of pure returns. You want to think of what we call risk-adjusted returns, right? If it's a high return, but there's a high probability that you will lose some of your money, that's one thing, versus a high return where it's a really, in your mind, relatively safe investment. Those are two different things. So, look, things have changed. We're recording this, in the middle of a global pandemic, and we've just, we're already in a recession. And so the returns that are being promised today are probably different than they were 3 months ago prior to this, when everybody and their mother was investing in real estate and everything is just going up and everything's great, and occupancy rates are almost at maximums and everybody's paying top rent. That's not true anymore. People are losing their jobs, and so now vacancies aren't, at least economic vacancies may not be as high, and it may be harder to increase rents, probably impossible to increase rents in this environment. And therefore, because the properties are, properties, as you know, Anthony, in multifamily, they're valued differently than your usual single family, residential, your own personal home. So when you're buying a home, you compare them. It's like a comparison method. So you look at what this house is selling for, and then you try and find a similar house in the neighborhood and see, well, what did that sell for, what did that sell for, and you kind of figure out what the selling price is, and that's kind of what you agree on the price is. With multifamily, it's all based on the income.
Right.
It's an income approach valuation. So the higher the income that the property produces, most likely the higher the value of the property. And so when the income starts coming down, typically you will see a decrease in the value of the property. And so all that to say is that the returns that you're speaking of, first of all, seem a little high, to be honest with you. Most people, the ones I've seen on average before this whole thing happened, you were probably seeing sponsors, which is the one putting all these together, probably offering somewhere in the 7 to 12% range from a cash on cash, sort of an ongoing basis. That's what the property will spit off once we stabilize it and do all our magic that we're going to do to it.
Yeah.
It probably spit off, somewhere between 7 and 12%. And then obviously there's an appreciation factor as well. So at the end of 5 years when you sell it,
right,
if you've done all the work and you've increased the income, then it's going to be, most likely it will sell for more. So when you factor in that capital gains and you combine both, you end up with something called an internal rate of return, an IRR, or maybe a total return. And those typically would have been, if you're getting 7 to 12 and then you add the appreciation, you might be looking at 15% or 16%.
Right.
I'm always hesitant to promise. I'd much rather under-promise and over-deliver than over-promise and under-deliver, right?
Yeah,
so
yeah.
Always hesitant to really project really big numbers, but certainly they're way more attractive than they are if you're simply, if you've got your money in a savings account or a CD or stock market. Very few stocks throw off dividends, and even although now they're throwing off better, but because the stock market's gone down so much, but you typically don't get too much income from your stocks, if any. And if you do get a good dividend, you're looking at 3 or 4%. So when you compare it to that, that's why I think real estate's been pretty attractive. Not to mention, income is only one of the reasons people like in real estate. I mean, one of the reasons most people like real estate is the tax benefits of it. I mean, especially after the recent tax overhaul from President Trump, you literally can deduct almost 100%. If you've got a good CPA and you do what's called a cost segregation, it's a big enough building, you will probably deduct 100% of that investment. So meaning if you invest $100,000 into a particular investment, you should get a $100,000 deduction from your income. So you're not going to be paying taxes on that 100,000. Again, check with your CPA, but it's called a bonus depreciation. And when you do a cost segregation study, in my experience and what I've seen, typically that investment gets kind of wiped out in year one because of the bonus depreciation, and then also even the income that you're getting from the building gets wiped out because of the losses that you can, from a tax perspective, you can take all these losses. So at the end of the day, you're not actually paying taxes on a lot of this income. So the tax benefits are probably one of the biggest reasons people like real estate.
That's awesome information that you just gave right there. And I completely agree. That seems to be everything that I've found recently, especially. I was listening to Neil Bawa. I don't know if you've ever heard that name.
The mad scientist.
Yeah, he's pretty interesting. I was just listening to the Cash Flow Kings podcast the other day where they interviewed him. And that was I was very impressed with that one. He really went into that tax deduction. He said it blew his mind. He said it was the number one thing that got him interested in it from the beginning because he couldn't believe that he'd been paying W-2 taxes all of these years and all of a sudden he's a real estate investor and he's paying less and making 10 times more or whatever the number was that he was making. So very impressive that there's a lot of opportunities with the tax savings there. So that's great.
I've got friends who, again, it's not going to apply to you on day one, but if you work with a really good CPA and you're a sponsor and you have multiple deals, I know several of the sponsors that basically pay zero taxes legally. I mean, this is all legal stuff, but with all the deductions that you get from real estate, all the paper losses that you get to offset with all the income, and then a lot of times the income you're getting is not really from the property, but it's just a refinance. You know, you're pulling cash out as a refinance, which is really debt. There's no way. So there's ways to, if not zero your taxes, significantly reduce your taxes when you're comparing it with a W-2, which obviously your taxes are off the charts.
Are you actually a real estate syndicator yourself also? Are you a sponsor?
No, I don't like to compete with clients. I feel like I'd be out there in the marketplace trying to compete against the same passive investors that my clients are. Right. But we've done it before. I mean, I used to be a managing partner at a mobile home park company, and we raised quite a bit of money while I was over there. But I'll probably wait until I'm semi-retired to do that again. Again, I just feel it would be a little bit awkward for me to compete, represent clients, and at the same time compete with them for the capital out there.
Yeah, totally makes sense. I agree with that. So let's see. What are some people that you respect in the industry? Can I get you to give us some tips on where we can get some other good information?
I think hands down, in my opinion, the best syndicator out there that I know is a gentleman by the name of Ken McElroy, who's one of the Rich Dad, Robert Kiyosaki's real estate advisor. He's been doing this since before. Well, I don't know if it's before the crash or right around the crash. I think it was before the crash. And, he currently owns, I think, just under 10,000 units, but that's because he sold a bunch. He's been talking about this correctly for a while, so he was kind of stopped acquiring. But he's a wealth of knowledge. And so if you haven't read any of his books or, go on his website, I think it's kenmcelroy.com. He's got some educational videos. He's putting out some ridiculous content on his YouTube channel these days about what's going on right now just in general in the economy and what's going on. So he's probably one of my top, in the back of my mind, one of the top syndicators out there. And Neil's another great example that you mentioned. Neil Bawa is an outstanding syndicator, very smart, engineering background, right? So he's got he can crunch the numbers and all that stuff. But there's so many great great syndicators out there that I think if you go on, you just look at the podcast circuit, you'll find them all there.
I listened to the Joe Fairless Best Ever Real Estate Syndication or Apartment Syndication Guide or something like that. That book I was really impressed with. I love that actually. I think that was probably the most in-depth syndication explanation that I've ever witnessed, and it's mind-blowing. The content that's in that is great.
Yeah, I think it's a best ever syndication book or something like that.
Yes, yeah, that was really good. So there's one other thing I want to talk about before I forget. Since the coronavirus happened, have you seen I've been so excited to do this type of thing for so long, and then when the coronavirus hit, I said, "Wow, that's kind of an eye opener because you're basically in charge of all this money from all these people, and when something like this happens, it puts you in a position that you came out of thin air, just out of the blue. Nobody was expecting it, and now all of these syndicators, I wonder how they feel about the whole, category now. Do they feel differently about it? Is it something that they're going to continue to do? And everybody seems fine with it so far.
For sure. I mean, the syndicators are all salivating because there's definitely going to be opportunities. A lot of people are seeing opportunities here in the next, it's debatable whether with the timing, but certainly within the next, 6 to 18 months, not sooner, you're going to see some really good deals popping up on the market. That's the general belief in the syndication community. So most of the calls that I'm fielding these days have switched a little bit from, hey, I just got into contract to buy a unit that I want to raise money for, to, hey, I want to put together a fund. I want to go raise a bunch of money, have that in my back pocket, so that when these opportunities start popping up, I don't have to wait, and I can go in there and maybe go in there with all the cash and get some really sweet deal, or be able to close really quick. And that's probably 90% of the phone calls I had, which prompted me to do that. I don't know if you saw my video, but on my YouTube channel, I did a video on, things to think about when putting together a fund, which is a little bit different than putting together a deal for a project specific or a specific property, because there's just so many questions that came up on putting a fund together. But the syndicators are salivating. I think the biggest challenge is just, what's the mood of the passive investors, with the stock market not doing great, are they getting nervous? Are they holding on to their cash? Or they're going to write that $50,000 check or $100,000 check? But if it was up to the syndicators, I mean, they were happy 3 months ago, and now they're going to see all of these deals that are going to be coming up on the table, because there are a lot of people. Look, syndication. Everybody was getting into syndication. There's certainly a lot of people, in my opinion, that got into syndication, obviously at the peak of the market, and maybe that was for a lot of first-time syndicators who weren't necessarily super experienced, got in there, and when you're not experienced, then you tend to not have the right amount of reserves, or maybe you overpaid for the property, or you just everything had to go perfect for you, and so when things don't go perfect, that's going to be problematic for a lot of people. So there's a lot of folks that are kind of eyeing those types of deals from people who overbought, overpaid, and then just don't have the reserves, don't have the experience, and can't hold on to these properties. And that's what people are excited about.
What about government subsidized versus, housing versus market value apartments? Are you hearing anything about maybe non-government subsidized being an opportunity, or... Because I hear that the government subsidized stuff, they're still getting rent. Yeah,
well, I think all of it is subsidized right now. All of the real estate is subsidized as we speak, but that subsidy is obviously going to be removed here shortly. But no, I mean, definitely your tenant base makes a difference on how your asset's going to perform. So, for example, I was actually listening to one of Ken McElroy's videos, and he specializes in sort of that B minus property type. So most of his tenants are professionals, and they're not sort of C-class properties where there's a lot of people in hospitality and restaurants and bars, which is probably the problem. But he has a lot of people, for example, who are elderly, right? And so if you have a building that maybe caters to elderly folks, well, they're retired. They've got a pension, or they got a whatever Social Security or whatever income they're relying on. Then they're less affected by all of these issues. But if your tenant base is, as I mentioned, hospitality, bars, restaurants, all of these, certainly if you work in the airlines or whatever, but that's going to be more problematic for those types of buildings, because those are the ones that most likely are going to be a higher percentage of those will remain unemployed versus, A-class, for example, where everybody's, high-paid professional, probably less affected. So the tenant base does matter. So from that perspective, if you've got a government subsidy, although a subsidy doesn't mean they're paying the whole thing either, so that's another thing. But yeah, I mean, all of those things are things that you need to consider when evaluating the property, for sure.
There was one other question I was going to ask you. Where do you find apartments that you can use as syndications to raise capital? So, like, I know of a really large one. I think I was telling you about this one before. It's the $60 million, 700-unit, 40-building complex. That's a pretty big syndication. But I think it's just sitting there waiting to happen. You just have to find the investors, and I have a lot of investors. And then we have you, and we have Matt Pacini and other people that can help put the deal together. So maybe we could make that happen, actually. I just don't know how big are we looking and where do we find it?
You're talking about the investors or the property?
The properties.
I mean, look, that's, if you're starting off and you're starting off small, that's probably not an issue. But at some point, I can't overstate the importance of, first of all, it's a general thing. Real estate, like most businesses, is a relationship business, right? And so relationships are key. So the quicker you can establish, and it's relationships with your investors, relationships with banks, and relationships with brokers. I mean, the broker community, most people will. It's not like your single family home. It's not like your home, your next door neighbor that they may just be for sale by owner. I don't think I've ever seen a for sale by owner of a 100-unit apartment building for millions of dollars. They're all put on the market via brokers, and a lot of times properties don't even make it to market because the brokers already have relationships with people, and so they're called these pocket listings. Well, they'll actually offer this deal just to that person because they know they have the track record. They know that if they're interested in, they can close, and they can close quickly, and there's not going to be issues. But the brokers are the key. So the challenge for a new syndicator is to really break into the broker community and get into relationships with the brokers. And it's tough. It's a catch-22 because the brokers want to make sure that you have the track record, so that they, if they offer you or not offer you, but if they give you the award, they give you the award of the contract that you're going to be able to close and be able to get the investor. So when you're just starting out, it's most people will partner with someone, right? Because they'll partner with somebody experienced who has those relationships, so that you maybe do the first two, get those first two under your belt with the assistance of a more experienced syndicator who has those relationships, so that by the time you go out on your own, it's not going to be your first rodeo. And when you're talking, you may already have a relationship with these brokers because of the partner, but at least it's not your first deal. Because as you get bigger and bigger, most people think that the price is the most important thing for a seller, and that's not necessarily true. Price is important, but much more important for sellers that you close. And sometimes they will take a lower, especially if there's a bidding war and you're trying to figure out which seller should I award the contract to go buy my building. It's not uncommon that not the highest bidder wins, because the person who's awarded the contract is somebody that has an experience and is known to close on these transactions. Because the last thing a seller wants to do is go through not a 6 month, but let's say a 3-month process. You fall out and can't close. Now they've got to start the process all over again and put it on the market again and do another 90-day, 120-day process. So, but to answer your question, that was a long way to say the relationships with the brokers, just like the other relationship you want to have is a relationship with a good property manager. I mean, it's just a relationship business. I can't stress that enough. And so just take those brokers out to lunch, to dinners, to baseball games, to just, just do whatever it is to get into great relationship with those brokers. That's where the property's going to come from.
Very interesting. Well, is there anything else that you can think of that's an important topic to talk about when it comes to real estate apartment syndication?
I think if you're a beginner, if this is your first deal, I think one of the main thing to remember is that you are issuing securities, and that's a lot of times people don't think of that. They're just like, hey, I'm just buying a piece of property. I'm getting 3 of my buddies or 5 of my buddies are all giving me a bunch of money, and I'm going to go buy this thing, and then I'll realize they're selling a security. So that's probably the biggest mistake I see. And then because most people use 506B, as we've talked about, you cannot advertise, and for some reason people don't think of that as well, or maybe they don't know step one, so they don't even know they're selling securities, and so they start posting these deals on social media, on Facebook and Instagram and LinkedIn, and they're like, hey, look at this, I'm raising money, and that's a big no-no as well. And so you just got to be careful on your social media stuff and just kind of stay away from that. And then the last thing that I like to bring up always real quick is you can't pay, it's tempting to pay other people to bring money to you, especially if you're a first-time syndicator. So you cannot do that. You cannot pay somebody to either bring somebody in as a referral fee or help you raise money in exchange for something. You have to have a license for that, and so that's probably the third biggest mistake I see people do.
Interesting. Is that what you were talking about? A broker dealer?
Broker dealer, yeah. So if you're going to, which nobody is, and so one of the issues that's very prevalent these days is people are out there partnering with others. So you may have a group of 4 or 5 people who are putting the syndication together, but only one of them is really raising the money, and they have all the relationships, and then that person ends up doing no work other than raising money and bringing money to the deal. And because they get compensated, in this form of, percentage of the company, but because they're getting compensated based on the amount of money they bring in, that's what we call transaction-based compensation, and that's prohibited if you're not a licensed broker-dealer.
Okay. So just off the top of your head, can you come up with some numbers of some properties, some syndications, the entire price of that purchase of the entire complex, and how many units there were? Do you have any numbers like that off the top of your head that you can think of?
I'm sorry, say that on a particular deal, or?
Yeah, like if you get to say, well, one deal was, $6 million for 100 units, for example. That's something out in Springfield. There's something like that right now available. Or, maybe it's in Boston, so it would be a lot more expensive.
It depends on the market you're in, right? I mean, if you're going to get even a fourplex in California, I can't imagine you're going to get the fourplex for less than $1 million, right?
Mm-hmm.
But yet, in another jurisdiction, $1 million might get you a 16-unit apartment building.
Right.
So it depends on that. I think the biggest number that I think you need to think about in your head is whatever the purchase price ends up being, you probably, this is before the whole COVID thing, you probably need to have probably about 30 to 35% of that in cash. So if you're buying a property for $1 million, then probably 35% of that, $350,000, you need in cash for a combination of a down payment, which is usually 20%, maybe going up to 25%, but let's just say it's 20%. Plus usually a turnaround investment, right? You're fixing up the units, you're trying to get the bad tenants out, whatever that's just. So that's value add that you're going to spend, and so that's how much money you need to raise between the money you have in your own pocket and the money you need from investors. That's the number. So if it's $1 million, you need $350. If it's $10 million, you need $3.5 million. So those are the things you got to think about. And then the other key thing, which we won't have time to get into in detail, but the lenders, a little bit different from single family, the lenders will require two things from you in general. It's very generalized. But number one, they will want to make sure that whatever the value of the loan that you're getting, that either between you or your sponsorship group, you guys have that amount covered in your net worth. Mm-hmm. So a lot of times you don't have enough net worth. Let's say you're getting $1 million loan, but you don't have $1 million in net worth. Then that's why you've got to go find somebody else who you can bring in to cover. So between my net worth and somebody else's net worth, we aggregate, get to $1 million. That's one thing they look at, which is not the hardest thing to do. The hard part is the liquidity. Typically, they'll want 10% of that in liquid cash or instruments. So if you're getting $1 million loan, they're going to want to see $100,000 in equivalent of cash, whether it's cash or 401ks or some treasury bills or whatever, but something liquid, which is another issue that some people have the net worth, but it's all tied up in real estate. They don't have liquidity.
Right.
So those are two other things that you want to think about on the lending side.
All right. Well, this is great information, Mauricio. Thank you so much for being on the podcast. I really appreciate it. And actually, one more time, can you give the contact information, name, business name, location, phone number?
Well, the website and YouTube, my YouTube channel under Mauricio Rauld or premierlog.net. But if people want, we didn't get a chance to talk about the social media advertisers. If anybody's interested in learning a little bit more about what you can and cannot do on social media or how to properly use social media to get more investors in the door, if you email me at social, SOCIAL, social at premierlawgroup.net, then I've got a 5-part video series that I put together with the sort of the do's and the don'ts of social media advertising.
Excellent. And how about contact you any other way, or do you want to just stick to the social?
You can do that, or if you just want to email me at team@premierlawgroup.net, that'll just be an email that gets to me. And if you've got any specific questions, follow-ups, or want to get on a phone call, happy to talk to you then.
All right, everybody. That's Mauricio Rauld of Premier Law Group. Thank you so much for being on the Real Deal podcast. It's an honor to have you, sir. And I hope to see you again the next time that you come around at that multifamily investment group networking meeting in Newton, Massachusetts.
Thank you, my friend. Thanks for having me on.
Happy Friday and enjoy your weekend, sir.
You too.
All right, everybody. Thanks for listening to and watching this time the Real Deal Real Estate Podcast. My name is Anthony Chabot with Chabot & Associates Real Estate Group of EXP. Until next time, thanks for watching and have a great day.